Good morning, and great that I see so many faces, most of them familiar, because I asked my family and friends to help me with this workshop. And they do, but I also see some new faces, which is great, because I want you to be very interactive, brutally honest and direct with me. I need you to participate. This is going to be an old traditional workshop. I was told it's a workshop. Therefore, I didn't want to make any PowerPoint presentation. Also because, as I learned, and probably you know, the best presentations I've ever seen in my life were without any PowerPoint slide. Think about Clinton, Obama. Yesterday I heard the speech of Peter Thiel, 1 hour without a single slide. One of the best ever. So this is the only slide you're going to see, it's my logo. My name is Eran Davidson, and I just launched recently, last year, the first debt fund in Germany, growth debt. What I found out, and this is very strange, but also very good surprise for me, that people don't know much about debt in the private sector, especially in the technology sector. We are all in. So I need your help, not only to get the message through, but also to understand what you know or what you don't know about venture debt. It's a big thing, but only starting. It's a big thing in the US, UK, Israel, and elsewhere, but it's only starting to happen now in Germany. And we will talk about it in the next 15, 20 minutes. Again, feel free to interact, to ask, to disagree with me at any point of time. It's a workshop, therefore, we're going to work together. And in order to do that, I will take my jacket. Please excuse me for a second, it's too hot. And now we're going to work a little bit about the topic of debt versus equity. First of all, let me know who of you has any kind of experience as an entrepreneur or an investor with venture debt, venture loans. Please raise your hand. 1, 2, 3, 4. Only, Yaron. 5 people out of 50. This is very low number. Now, whoever raised his hand, what kind of experience was it? Good, bad, and also what kind of investor was it, or what kind of loan? Was it from a bank, from a fund? Please give us some information about it, based on your own experience. Good experience, bad experience. Who put his hand up and would like to share this experience with me? Yes. Come closer, please. Guys, can we get another microphone? No, I think it's okay. Okay, go ahead. What's your name? Malte. Of course, I can't see you. Malte, sure.
Yeah, we've talked about it a few times. So my experience both as an investor and as an advisor.
We can't hear you, but Malte, come closer. Come up. Malte is a good friend.
Hi, Eran. Well, we'll see how good a friend I am after this.
He used to be a good friend.
Well, my experience is both as an investor and as an advisor. As you know, I've been with a family office, with a single family office until last April. And we've done a few what I would call venture debt investments, though it depends on what you really call venture debt. Nowadays, I prefer what I call working capital financing, also early stage working capital financing. And I would say I've been probably a bit lucky because so far my experience is good, though a few financings are still up and running. And well, I haven't had any insolvencies, which I think is a real risk.
So you pay back your loans?
We got back our loans, we got back our...
You pay back, you mean?
We got the payback, we got a good IRR, and...
Oops. We had a
So-
little accident, but
Yeah,
we're fine.
we haven't had any accidents so far in investing. So
As a
far my
lender.
experience is good, but I'm still thinking about good structuring and how to better avoid the risks I
Default.
see. And yeah.
Yeah, great to hear, but we'll get more into details right now.
Do you want your microphone back?
We may need it later on. Anybody else want to share his experience with venture debt? Debt in general in IT companies? I have a lot of experience with that. Yaron, where are you? Yaron Waller? He's not here yet. Shmulik? Not here yet. Two of my former colleagues at House of Platinum Ventures, when we took loans to some of our best portfolio companies, and even give loans to some of them. And I will share my experience with you regarding, let's start with the debt side. What are the advantages, or why is it so good and even better than equity? Of course, you can disagree with me, as I said earlier, but let's start to list down the advantages. Give me one. Let's start with you. What is the best one, the biggest advantage of debt over equity? Dilution. Absolutely. No. No dilution to the founders, but also to other investors. The founders are most sensitive about it in a later stage. The second big advantage, cost of money. Cheaper than equity. I will prove it to you. Cheaper. Do you need some more help, or can you help me too? There are many more advantages. Think about it. I want you to think. Sorry? No given control. That's what you want to say? You keep control of your own company. A lender doesn't take any veto rights. He is not sitting as a board member. He let you run the show by your own. What else? I can give you another hint. You don't spend time on raising capital from a lender. You let your CFO do it, your banker, someone. It's no distraction for the management. No distraction. These alone are good enough for you to prefer debt over equity at a certain point of time, but there is much more than that. In the case of debt, it's fast, it's simple, it's easy. Therefore, simplicity is a big advantage. You can close a deal with a debt provider within 4 to 6 weeks, compared to 3 months with an equity investor. Now let's compare that to equity. What is the cost of equity? Basics, right? You all know that the first, or the best, or the easiest way to come up with the equity price for you is the last valuation, right? If you want to raise a new round, the benchmark is the last round valuation. Maybe you have an up round, maybe a down round, maybe a flat round, but there is already a valuation set between you and the investors. Therefore, the cost of equity is first and most important, last valuation. Compared to no valuation here. There's no negotiation regarding valuation when it comes to debt. This alone is a deal breaker to many fundraisers, because entrepreneurs would always think the company has a very high valuation to avoid dilution, while investors would like to take the valuation down because they want more equity, naturally. As I said, this is a single reason why many deals fail to mature, for that issue of cost of the equity. Very simple example. Most of the companies we have negotiated and signed deals with have a valuation of 50 to 100 million euro. Let's take a 50 million euro company. The founders normally have less than 10% equity. With 10% equity, if they give away 1%, which means 10% dilution, it's €500,000 out of pocket for them. €500,000 out of pocket, compared to zero cost for them if they take debt. Do you get it? Most entrepreneurs really don't get it. They give away equity because they think it's cheap money and they don't need to pay it back. But we talk about mid to late stage companies. A company with 50 million valuation, a founder will give millions out of his pocket when he wants to raise equity. So first of all, that. Now second, there are a lot of hidden costs for the equity, which most people are not aware of. Even the most experienced entrepreneurs I know, they focus on that first issue. But they forget there are many side issues. We are experienced, as experienced investors, know how to structure a deal with a very high valuation, theoretically, for the press release, but in practice, it's a very good deal for the investors, not necessarily for the founders and the entrepreneurs. For example, liquidation preferences. Liquidation preferences, 2x, 3x. In many cases, especially in down rounds or in low number exits, the investors will get all of their money back, 2 times, 3 times, before anybody else will get any money out of the company. This single item left many very successful entrepreneurs completely broke after an exit, without any upside. Now, let's talk about control. When an investor comes in, he wants to have a board seat, veto rights, etc., etc. You are not the owner of your own company anymore. Here, you keep control. You're the owner.
Sorry, can I ask you a question?
Yes. Sorry?
It looks like we're looking at the advantages. Right. It looks like we're looking at the advantages of the debt and the disadvantages of equity. I thought we were comparing them.
This is comparison.
No, this is like advantages of debt and disadvantages of equity.
I take it as a good criticism, and I agree. I'm a little bit biased. You can imagine why.
Very biased.
But again, if you disagree, tell me why. Because we talk about very specific situations, and I'm going to get to it right now. The situation is the status of your company, that you have 20 million of revenues. And this is a real case example. I will give you the name of the company later. You have 20 million revenues. You have a valuation of 50 million euro. In the last transaction, investors already put in 20 million in the company. And you, as a founder, have less than 10%. Now, you're short of 5 million to get to break even. You're not yet profitable. 5 million needed. What do? You can raise equity. You can raise debt. Can you go to a bank? What do? This is an example, 1 out of 50 companies I can name one by one that exist in Germany. All in the range of 10 to 100 million revenues. All are short of 3, 5, 6, 7 million from break even. The founders have less than 10%. In case of rocket internet companies, they hold less than 5% each as a founder. and they need a little bit more money. They need to buy in a competitor, they want to go international. Now I'm very objective. What do you do? Question to you, what's your name? Ardian. Ardian. Okay, what do you do? You need 5 million. This is your company, and this is a real company. There are many of them. Any idea? Guys, help me. It's interactive, it's a workshop. Yes? You can raise equity, right? You give away 10% of it. If you're lucky, you get the same valuation. Debt, can you take that, please? I see I have a rival here. Argue with me, disagree.
Okay, the downside of debt is you can also, it's not true that equity leads to loss of control and debt does not lead to loss of control. Debt also leads to loss of control if you cannot pay back the debt, right?
Absolutely.
That's the downside of debt, right? So there are two cases in debt.
Yeah.
One is you pay, the other one is you don't pay. If you don't pay, you lose control, right? With equity, there is no you pay or you don't pay, right? So it's an in-between situation, but it's not true to say one is control and is not. Here you could do either one. You could raise debt, or you could raise equity and you could maintain your proportional control of the firm.
What you're saying now is very disturbing because you say, well, equity I can easily take because I don't need to pay it back, and who cares? I don't, excuse my French, fuck the investors, I keep my money in the company. But that's what you say in a down, that's what goes through your mind when you go to bed. But that, oh, okay. Okay. I said, sorry for my French, but in the real downside, so-called downside of debt, that you need to pay it back, of course. But we talk about companies with, at this stage, already 5 to 10 years old, they're not going to get out of the market overnight. When people like that take debt, and there are many of them, they intend to pay it back. Of course, if they don't, it's a default, and then the debt provider have some securities, he can get his money back, while investors cannot get their money back. But it's not, of course, the conclusion is very clear. Debt is the best solution. And the truth is, and the fact is, companies like that approach me now every day. And we have many term sheets standing out, waiting for approval by investors. And finally, why is this the best solution for them?
What is the cost of that debt?
Sorry? The cost.
What is the cost?
That's exactly my next so-called slide. The cost of equity and the cost of debt. Cost. Debt, equity. An investor in every startup, especially at that mid to late stage, would expect to make how much? Cash on cash? Give me an idea. 5x? 10x? We talk about cash on cash return for equity investors. I wouldn't invest. I'm a 20 years equity investor in 6 different venture capital funds. I would never invest for less, theoretically, upside of 5x cash on cash within 5 to 10 years. Debt, my modest return will always be 1 to 3 to 1.4x. This is the cost of equity. This is the cost of equity for you. This is the cost of debt for you as a company. In IRR terms, IRR. This equity side would expect to appreciate his investment 30 to 50% per year. Every year, an equity investor would like you to your company to grow by that percentage. And the debt, the cost of debt, not more than 10 to 12%. This is what it costs you if you take a loan. That's all. Of course, you have to pay it back, but you also need to pay back with your equity. And we talk about companies that already show good signs of success, that are close to an exit, and everybody knows they're not going to be a write-off for the investors. So what is the cheaper? This is the answer, exact answer to your question. Are you convinced or not yet? Not yet. Okay. What is wrong with this analysis?
What is the cash outflow cost?
Cash out for?
Cash outflow cost of debt. You're saying it's 11%.
One.
It's 11%. So I raise €1 of debt. I pay 11 cents
Per year.
next year.
And this is what you pay for, yeah.
And next year, I have 0 cash outflow.
Look, I appreciate that you oppose me, that's fine. We can continue this discussion, but these are facts. This is fact. You can't argue with facts. Finally, yes. Can you take the microphone, please? Malte? We have 2 more minutes? Yeah. And I will sum it up very quickly.
When I'm looking at this, I'm getting a bit worried that you're watering our conditions, the market conditions. When you're talking about the 10 to 12%, you're only talking about the interest rate, right? No commitment fee included, no virtual equity kicker included, and so on, right? The 10 to 12% is just the interest rate.
Correct. Of course, for me, the return, this is the cost for the company. For the investors, both here and here, there are more upside potential, especially with the equity kicker. Fees are nothing. It's 1%, but it always costs also when you raise equity, legal fees, and etc. But additional upside for me as an investor is an option in the company, but not more than 1 to 2% virtual options, not real money out of your pocket, and no dilution for you. This option is exercisable. We can execute it only upon exit. If there's no exit, we don't get anything. Finally, and this is the to sum it up, this market, yes, last.
Could you talk about personal guarantees?
No personal guarantees needed whatsoever. The only security we get is what we find in a company, inventory, IP, if there is some IP, but it never covers the risk of the lender. It's a high risk, don't forget. It's still a high risk loan for companies that are not profitable. They are not yet bankable because they don't have any tangible assets, no real estate, no machinery. It's all virtual. We invest in people. Last but not least, we talk about a market that exists in the US for more than 35 years with lenders like Silicon Valley Bank, Hercules, and many other big funds. Maybe you don't know, but you should. Facebook took €100 million loan after Microsoft invested 300 in the company. Why did Mark Zuckerberg took a loan? He's not that stupid. He didn't want to give away equity. It was much cheaper for him to take debt. Amazon took 70 million. YouTube took 50 million. I can give you a long list. Etsy, another 50 million. All those companies were financed by debt. The private sector, VC-backed companies in the US, the debt to equity ratio is 15%. 15% of all transactions on VC-backed company is debt financed. How much is it in Germany? Any idea? 0 point something. Why is it so? People first didn't have me around. That's one reason. But okay, there are some other UK providers of debt. And they did some deals. And now behind the scene, without you noticing, the most successful startups of Berlin, around here, raising hundreds of millions of debt. Do you know Delivery Hero? I'm sure you do, right? The highest valuation startup in Germany, 3 billion. How much debt do they have? Oh, do you know at all if they have any debt in their balance sheet? Any idea? I can disclose a big secret. 120 million. 120 million, which is part of €500 million invested in Delivery Hero, is debt. Did you know that? You didn't, right? Think about...
Ladies and gentlemen, I'm so sorry we have to cut in there. Put your hands together for Eran from Davidson Technology. Thank you very much. I'm sorry, we have to move on very quickly. Thank you very much.
Okay, so who thinks equity is more expensive than debt? Still, more expensive. Who thinks debt is cheaper than equity? Please raise your hand. I convinced half of you. That's good to know. Thank you very much, guys.